Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 5th of December, 2019. And in the past couple of days, we've produced 3 videos. Gold and silver prices rise as China trade deal delays. US versus France at NATO summit, market implications. Stocks fall, gold and silver rise after poor ISM data and tariff threat, where we discuss in all 3 that poor US economic data, coupled with the trade deal in China looking as if it's going to be delayed, and also President Trump threatening additional tariffs to other countries such as France and the EU as a whole, if necessary, and admitting that he will use tariffs as a means of balancing the score with those countries not paying their fair share of 2% of GDP to finance NATO and the defense industry, has caused the dollar to fall, equity markets to decline, and gold and silver prices to rise. Well, that was until yesterday, when we saw a slight reversal. Bloomberg report by Adam Haig and Todd White, December 4th, 2019. Stocks edge higher as next tariff deadline looms. Markets wrap. European stocks edged higher with US equity index futures on Thursday after a mostly positive session in Asia, as investors weighed the prospects of America removing a scheduled tariff hike on Chinese imports in 10 days. The dollar drifted lower. Retail and utilities were among the leading sectors as the Stoxx Europe 600 index edged up, although German shares dipped after the country's factory orders unexpectedly fell. Contracts on the 3 main American equity gauges were also marginally firmer. Earlier in Asia, most major stock benchmarks posted solid gains, although shares in South Korea fell. An index of emerging market equities climbed. Treasuries held their losses from Wednesday when a report indicated the US and China were closer to a deal that would avoid the next round of tariffs. India's government bonds tumbled after its central bank unexpectedly left interest rates unchanged. The pound rose for a 5th day against the greenback as expectations grow for a conservative victory in next week's election. Investors are focused on whether a Phase 1 trade deal can come together in time to avert another scheduled hike in American duties on Chinese goods, a result that many say is priced into various asset classes. With fears of a global economic slowdown subsiding as the year draws to a close, concern has shifted to the prospect that political tension will infect progress on trade, particularly US support for Hong Kong protesters and Chinese Muslims. Quote, "If we do just muddle along, and there aren't the tariff increases on December 15, we'll probably see something of a stable stock market environment," unquote, Christina Hooper, Chief Global Market Strategist at Invesco Limited, told Bloomberg TV. Any negative trade news, quote, "could be the spoiler for what otherwise would be a fairly solid month for stocks," unquote, she said. Elsewhere, iron and steel stocks led gains in Japan after a government stimulus package was announced as 26 trillion yen, slightly larger than expected, to support growth. Oil futures nudged lower, but largely preserved this week's rally after Energy Information Administration data showed US crude inventories fell more than expected. The Dow Jones actually rose 0.5% or 146 points, and the S&P 500 rose 0.6% or nearly 20 points. Now this morning, all European markets are in positive territory, and so are Asia-Pacific markets. Gold, at the time of writing, which is 10:30 GMT, stands at $1,474, and silver has fallen back quite substantially to $16.83. Now, during our weekly update published last Saturday, we actually stated to expect this week to be somewhat topsy-turvy, with gold and silver prices vacillating And so far this has been the case, albeit within a relatively modest high to low band. Now, as discussed many times, the issue of China is dominant. And it's all a question of, is there going to be a trade deal? Or is there not going to be a trade deal this year? To some extent, dictating short-term market movements. What is noticeable, and potentially concerning for those looking for much higher silver prices, is silver's reluctance to hold above $17 for any length of time. And to be fair, even we thought it would stay within that $17 to $17.50 band for longer than it has. And we are far more pessimistic than many of the other YouTube channels. Now, there are a number of reasons for this, which we shall now go into. The first thing we should consider is that before the end of the year, there is likely to be some profit taking, especially for those involved in paper contracts, more so than necessarily those holding the physical. You see, gold is up 19% and silver is up 16% this year, and that's very credible and creditable. And with such returns, with high leverages, which the paper markets are in, it would not be unreasonable to expect some profit taking to occur. There is also a tendency to liquidate silver holdings more at this stage, as there is a fear that silver will be more adversely affected by any economic downturn. Now, secondly, and it pivots to what we've just said, and as we mentioned in yesterday's video, silver has to contend with a degree of schizophrenia. You see, if world trade declines, the industrial demand, which represents close to 60% of silver demand, although this has fallen a little bit, falls. So the industrial demand falls in a recession, while monetary demand, as silver is seen as a safe haven asset secondary to gold, increases. And this interrelationship makes silver both attractive and unattractive, depending upon which factor is stronger. Thirdly, despite what the pumpers would have you believe, there really is no shortage of silver, and we've produced numerous videos on this subject recently. With supply versus demand being close to balance or in marginal deficit, I think the last year's figure was 80 million ounces, there is more than adequate above-ground stocks to take up the slack, and depending who one asks, anything from 1 billion ounces to 2 billion. And so what incentive is there for investors to hold it, unless they felt an economic or equity crash was likely in the near future? Now, gold is deemed more attractive, as it truly is regarded as a pure monetary metal, with less than 10% being used for other purposes or for industrial purposes. And this is why central banks are such large purchasers and almost completely ignore silver. You will be hard-pressed to find many central banks acquiring silver. And if anyone's in the know, it would be them. This is also why in recent times the gold to silver ratio has held above 80 to 1, whereas recent history suggests it should vacillate between 50 to 1 and 70 to 1. And the ratio today is 87 to 1, and it was not that long ago when it was 93 to 1. Now finally, silver is more volatile than gold. It's a smaller market, and sizable investments or withdrawals have a greater impact on its price. This is why when gold rises due to economic uncertainty, silver follows, and occasionally, and we emphasize that word occasionally, supersedes its rise in percentage terms. But that is usually in times of quite major destabilization. And, to be candid, is the holy grail that those of us who are termed silver stackers secretly but rarely publicly admit to, dream of or dream for. The downside, of course, is that when there is a downward correction, we see silver more adversely affected. This can be shown quite simply by taking gold's high and low of the last 10 years, and it reveals a decline of 28% differential, whereas silver's high and low over the last 10 years has a 72% differential. So the conclusion of this is that, and we all know this to be the case, silver has greater volatility and risk associated with it as an investment. It has the capacity to outperform gold, but generally, as a rule of thumb, it doesn't, as we have shown in our videos, highlighting and asking the question, is gold an efficient or effective inflation hedge? And is silver an effective or efficient inflation hedge? And we've placed links to these videos in case you haven't listened or watched them, or perhaps have forgotten about them, in the description box below. Now, having said that, we must also accept that gold has been on a tear, and in many countries is close to its all-time highs. But that's usually because, to a large degree, of those countries' currency devaluations. Whereas silver generally has a lot of catching up to do, so that in itself should suggest something. So there is potential for silver to outperform. That is true. It has this catching up process. Now our view, for what it is worth, is that silver will have its day under two main scenarios. One, serious financial disaster, where gold reaches levels beyond the affordability of the normal man in the street or the average investor, and they turn to silver as a substitute monetary metal. The second case is when industrial or commercial demand for silver outstrips the ability of miners to mine it in sufficient quantities to cater for the demand. Now, in the current economic cycle, the latter appears at least to be very unlikely, let's be honest about it. Certainly right now. Yes, there could be an invention, and haven't closed our minds to this. There could be an invention which everyone deems they must have, and this could break the trend. But failing these options, we simply cannot see any reason why silver should rise to the moon anytime soon. It may very well increase a few dollars. When investors feel that the gold to silver ratio is out of kilter, that is true. And of course it will rise if there is a stock market fall of significant proportions, even without there being necessarily an economic disaster. We all know stocks are entering into bubble territory if it's not already there. So we cannot rule those options out either. But these are the reasons we're comfortable in forecasting that $100 silver, or even, to be honest, $50 silver, is extremely unlikely in view of the economic data and the relative recessionary global climate, both only at best being mildly supportive of the silver precious metal. Now, as a last missive, we must also bear the following in mind. If we do have a deep recession in the West, not necessarily economic crisis, but a deep recession, leading to higher unemployment and or lower wages eventually, as the shifts of this world predict, the normal man in the street will not have enough personal resources to buy gold and silver. They will be more focused on daily survival and keeping a roof over their heads. This means that only the extremely wealthy and large institutional funds will be in a position to boost the precious metals market to the heights that the pumpers forecast. And the irony of all ironies is that these prices will be inflated primarily due to paper trading, as opposed necessarily to the physical acquisition of the precious metal, at least in the short term. And finally, if their prices rise because of a US dollar collapse, then the people of the United States also have to bear in mind. Under those circumstances, $10,000 gold and $200 silver will mean that a loaf of bread or a litre of milk will cost around $22, as opposed to around the $2 or less that it is now. So will you really be better off? Unless, of course, you have a humongous load hidden under your bed. But beware, you will also need to have people who can either afford or are willing to buy it from you too. Now, we hope you found this useful and not depressing. The key message is simply just to be realistic and save or stack your gold and silver sensibly and bear the longer term in mind, as opposed to thinking that a quick kill is just around the corner. Remember, an economic collapse has been forecast since 2008, and it still has not occurred as yet. One day, we've no doubt that it will. But the signs at the moment are that despite pressures, and we all admit they are there, central banks and governments are managing to delay the process. And please do not be surprised if they manage to delay them much longer than some people in the YouTube stratosphere are predicting. Thank you for listening. If you haven't already done so, please subscribe to this channel, not forgetting to press the bell sign so that you'll be notified as new videos are published. And if you are not a member of our inner sanctum, either a free or paying member, then please pop along to illuminatisilver.com to the sign up page, and we look forward to welcoming you there. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.